In the world of cryptocurrencies, one of the biggest challenges is market volatility. Cryptocurrencies can experience extreme price changes over very short periods, leading to both opportunities and significant risks for investors. However, there is a category of cryptocurrencies that specifically addresses this problem: stablecoins. Stablecoins are cryptocurrencies whose value is tied or pegged to a stable asset, typically a fiat currency like the US dollar, the euro, or even gold. Unlike other cryptocurrencies, such as Bitcoin or Ethereum, which can see significant price fluctuations, stablecoins are designed to maintain a consistent value, making them a popular option for those looking to avoid high volatility. The concept of stablecoins arose from the need to create a bridge between the world of cryptocurrencies and the traditional financial system. By being backed by tangible assets or specific control mechanisms, stablecoins aim to solve one of the biggest problems of cryptocurrencies: their instability. There are several types of stablecoins, each using a different mechanism to maintain their stable price. One of the most common types of stablecoins is the fiat-backed stablecoin. These stablecoins are fully backed by cash reserves or equivalent liquid assets. The value of the stablecoin remains constant because for every unit of cryptocurrency issued, there must be an equivalent amount of fiat currency held in reserve. A well-known example of this type is Tether, USDT, which is backed by the US dollar. Tether has become one of the most popular stablecoins due to its parity with the dollar, allowing cryptocurrency users to make transactions without worrying about market fluctuations. Another type of stablecoin is the cryptocurrency-backed stablecoin. This type of stablecoin does not depend directly on fiat money but on other cryptocurrencies, such as Bitcoin or Ethereum. To ensure the stability of its price, these stablecoins use a collateralization mechanism. For instance, if the value of the cryptocurrency used to back the stablecoin drops, the system can liquidate part of the collateral or ask for more collateral to maintain stability. An example of this type of stablecoin is DAI, which is backed by cryptocurrencies like Ethereum. DAI is a decentralized stablecoin, meaning it doesn't rely on any central authority. Stablecoins can also be algorithmic, meaning their value is maintained through algorithms and smart contracts. These systems use a series of rules to adjust the supply of the stablecoin in circulation according to demand, ensuring that the price stays as close as possible to the value of the fiat currency it is pegged to. A well-known example of an algorithmic stablecoin is Ampleforth, AMPL, which adjusts its token supply based on demand fluctuations. One of the biggest attractions of stablecoins is their use in the world of decentralized finance, DeFi. Thanks to their stability, stablecoins allow users to participate in lending, exchanges, and other activities within DeFi platforms without worrying about the volatility that affects other cryptocurrencies. Furthermore, stablecoins are particularly useful in countries with unstable economies or high inflation, where people can use these coins to protect their purchasing power. Despite their advantages, stablecoins are not without risks. One major risk is the reliance on the reserves backing these cryptocurrencies. If the reserves are not fully audited or managed properly, there is a risk that the value of the stablecoin may not hold. Additionally, algorithmic stablecoins may be vulnerable to market manipulation, casting doubt on their stability during periods of high demand or economic crises. In conclusion, stablecoins represent a significant advancement in the world of cryptocurrencies. By offering a digital currency option with a constant value that reduces the impact of market volatility. As stablecoins continue to evolve, they will likely play a key role in the mass adoption of cryptocurrencies, especially in decentralized finance and in countries with unstable economies.